In this video, we're going to discuss the 3 components and the 3 steps to calculate your first pension. That's coming up, so stay tuned. Hi, I'm Jarrell Harvey with Fedway Financial, and this is the Money Briefing. On this channel, we cover topics related to personal finance, federal benefits, and retirement planning. So if you're new here, consider subscribing. Understanding the components of the FERS pension is important to strategic financial planning. Your FERS pension is an annuity, which means after you retire, you'll receive monthly payments from the government for the rest of your life. Your pension is mostly funded by the government, but every pay period, a small portion of your pay also goes toward your retirement pension. However, the pension calculation and the size of your pension are not based on how much you contribute during your career. Rather, your pension is based on 3 factors: your high 3 average salary, your length of service, and a pension multiplier. Before explaining the 3-step calculation, let's first review each factor. Your high 3 is the highest average salary you earn during any 36 consecutive months of service. It includes your base pay and locality pay, but it does not include any bonuses and overtime. Usually, the high 3 is your final 3 years of service, but it can be an earlier period. Also, your high 3 does not have to be 3 calendar years that run from January to December. It can start and end at any month of the year. The second factor is your length of service. This number may include all credible civilian service, any bought back military time, and any unused sick leave. Retirement pensions are based on years and full months of service. Any days that do not add up to a 30-day month are discarded. When doing your pension calculation, it's important to proportionally credit any full months of service. To do so, simply divide your number of months by 12 and add it to the last full year of service. The third factor is the pension multiplier. The good thing is that it can only be one of 2 numbers. If you're under age 62 when you separate from the federal government, or if you're age 62 with less than 20 years of service, then your multiplier is 1%. The majority of people fall in this category. But if you're age 62 or older when you retire and have 20 or more years of service, then you get a 10% bump and your multiplier is 1.1%. Now that we have a good grasp on the 3 components, to illustrate how the 3-step calculation works, let's consider a hypothetical situation. Michael is currently 55 years old, and he's thinking about retiring from the federal government in 5 years. At that point, Michael will be age 60. His length of service will be 26 years and 9 months. His high 3 average salary is projected to be $130,000, and since Michael will be under age 62, his pension multiplier is 1%. So the first step is to multiply Michael's length of service of 26.75 times his pension multiplier of 1%. Step 2 is to multiply the 0.2675 by his high 3 of 130,000, which equals his gross annual pension of $34,775. Now, some people may stop at step 2 with the annual pension amount, but since the pension is paid out monthly, and most people set their household spending based on monthly income, I prefer completing step 3, which is dividing the gross annual amount of $34,775 by 12. This produces a gross monthly pension of $2,897.91. However, let's take this scenario one step further, because after completing the pension calculation, Michael doesn't believe his estimated pension and other sources of income will be sufficient enough to meet his needs in retirement. So Michael also considers delaying retirement for 2 additional years. At that point, Michael will be age 62. His length of service will be 28 years and 9 months. His high 3 average is projected to increase to $134,000 because of cost of living adjustments, and his pension multiplier will increase to 1.1%. Step 1 is to multiply the length of service by the pension multiplier. That equals 0.31625. Step 2 is to multiply that number by the high 3 average of $134,000, which gives you a gross annual pension of $42,377.50. And step 3 is to divide the annual amount by 12, which equals a gross monthly amount of $3,531.45. By doing these two quick calculations, Michael is able to make a more informed decision about retirement. By delaying his retirement, he can potentially receive an extra $633.54 per month. I do want to point out that the two numbers that we calculated are gross numbers. The net amount that actually gets deposited into your bank account will be lower due to deductions for taxes, spousal benefits, and insurance premiums. So you will want to take those things into consideration. But by understanding the three components and the three-step calculation, you will have a good foundation to work from. If you received any value from this video, please click the like button and share our channel with others. Also, feel free to add any responses or questions in the comment section below. Thanks for watching, and we'll see you on the next Money Briefing.